In this video, we'll talk about a mistake that cost me $20,000.
Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
This is Raman from Trading with Venus. So, my $20,000 mistake. All right, so this happened back in 2010, 2011 when I had first started trading full-time. At that time, I was kind of new. I had been trading for about 3 years. However, I had not been trading full-time. And the way I came to my mistake was because we had recently gone through a big financial crash in North America, which had ripple effects throughout the world. During that time, we saw that the real estate markets completely crashed, the bubble burst, Wall Street crashed, and within a couple of days, market had just gone crazy. And then we had that ripple effect for months where different businesses were going out of business and many banks were actually getting bailed out by the government. During that time, as I was trading, I wasn't brand new, but I had been trading for about 3 years. However, that was the first time I was actually trading full-time. Normally, we're not surrounded by other traders. We can see them in forums and stuff, but we do not have anybody that we can really go to. And during this time, I had about a $100,000 account that I had grown from $25,000. So I started off with $25,000. Over the period of a few months, I grew it to about $100,000. And then things went crazy. And the reason for that was because what was working when I grew my account was the technicals. Markets were reacting to the technical levels and everything was going great. Then the Fed decided to start cutting rates. Prior to the big financial crash, the central banks had high rates and they were actually usually would be raising rates, not cutting rates. After the financial crisis, the Fed cut rates and then they started to do the QE2. And this is the time where I lost money because I did not understand what QE was or QE2 was. So QE stands for quantitative easing and QE2 means this was the second round of quantitative easing they were doing. So what is quantitative easing? This is the monetary policy and this is the stuff that we are going through today or will soon go through. Fed is ready to cut rates. Next week we may see that Fed may do a quarter point rate cut and we have heard different Fed members come and talk about that. So back in the day, first of all, I did not understand the Fed too well. I did not understand what roles the central bankers play in our business or in the markets or in the economy. I did not understand how Forex markets reacts to these interest rate changes and monetary policy changes. And this is what led to my big mistake. I happened to be trading the pound dollar and euro dollar during that time. As soon as Fed announced that they were going to cut rates, US dollar dropped. The problem there was I was in this trade where I was against the market. As soon as they cut rates, US dollar started dropping and all the dollar crosses started going up. The problem during this scenario was that I did not really understand the reasons the US dollar was dropping and everything else was going up against the US dollar because around the world everybody had the same problem. Eurozone had their own issues, UK had their own issues, and so did the US. So I didn't understand why US dollar would drop where the others weren't dropping. And I thought I understood fundamentals. What I didn't understand was that ECB wasn't cutting rates, Bank of England wasn't cutting rates. The only bank that was cutting rates during this time was the Fed. So this is our monetary policy. The Fed or the central banks try to manage the economies and the markets by managing interest rates. And that's called monetary policy. When they have an expansionary monetary policy, that means they are cutting rates, they're putting more money into the markets. So the more money that goes into the market, the cheaper that thing becomes. So it's supply and demand. So the currency will decrease when there is an oversupply of that currency, which is what the central banks are doing. They are putting more money into the economy so that the businesses have money to actually use to expand their businesses. The way monetary policy works is when they go into an expansionary monetary policy, the central bank will fund the banks, the chartered banks, which in turn, because they have the money, they will then lend that money out to businesses. When the businesses are able to borrow money at cheaper rates, they then go in and invest that money. They may build plants, they may actually buy equipment, or they may hire more people because they can increase their profits by doing those things when they're getting money for a cheap interest rate. And this in turn kickstarts the economy because more people are working, they have more money in their pockets, and then they go and spend more money. So that's essentially our expansionary monetary policy. What the Fed has been doing recently is that they have been raising rates. So last year we saw Fed raise rates. What happens with that is it actually stops the economy. Because the economy had been going really well, all the money that was injected in the economy, it actually did the job that it was supposed to do. There's better employment, things are doing well, real estate is up. Things are great in the US. Most people are working. So monetary policy did its job. And that's why Fed now wanted to stop the tap, turn off the tap, because if they put too much money into the economy, that economy will go overboard then and will have the negative impact. And in order to let the economy run on its own without the support, they started removing that support system, which is by increasing interest rates. Now we are back into the place where that is changing. With all the trade war concerns that different central banks have around the world, and now that the economic conditions are not looking as rosy as they did before, central banks are changing their policies and now they're cutting rates. So when they're cutting rates, there's more liquidity or more money in the market, more supply. That means the currency value will decrease. And that's what we are starting to see now. So with Fed cutting rates, it is negative for the US dollar. That means other crosses will go up against the US. All of this is called understanding the macros or the fundamentals. So if you are a person or a trader who believes that you can be successful just trading the technicals, I have news for you. I lost $20,000 with that mentality. That is not the mindset that we need as successful traders. If you truly want to be successful in this business, you need to understand what drives the market. What are the different factors that will impact the market? Tweets from President Trump definitely moved the market, so we need to understand what impact those tweets have. Iran situation, understand that because it will have an impact on the market. Right now, the situation is neutral, nothing is happening, but as soon as that escalates, it is going to impact the market. So what happens during that time? If the tensions go up and we start seeing that there are attacks on Iran or Iranian ships, or there's conflict in that area, we will see safe haven assets go up. So Japanese yen, Swiss franc, gold, silver, those are the assets that are likely to go up. And if we see trade tensions actually escalate, so if US and China are not able to reach an agreement, we will again see that our safe haven assets will go up. However, right now, we have seen comments that say that US and China are actually talking. They are working on the negotiations again. That is positive news. And as a result of that, we have seen the equity markets go up. So there is a relationship between different markets, as well as there are factors that we need to understand that drive the market. So it's not about the technicals, it's not just about the system, it's about understanding the overall market. Just like if you were playing football, for example, you would want to understand your own role. So you need to understand what kind of cuts you're doing, but you also need to understand what the different players are doing on the field. So you have to see where the other player is so you can pass the ball or you can go there to get the ball from that person. Also, you would want to understand what other factors will have an impact on the game. For example, if it's raining, you will not play the same way during rain as you would in dry weather. What if it's really windy and you're not able to get the same trajectory for the ball that you would otherwise? So you need to understand what impact the environment factors have on the game. Or if you are injured, so let's say you have a knee injury, now you need to compensate for that. So you need to understand how that injury will impact your game and what you need to do in order to compensate for that. Same way, we need to understand the macros. So what could have an impact on our trading besides just the technicals, what things will actually impact the market and how do we then compensate for them? And the best way to work on that is by understanding them, learning about them, and then putting them into place in your trading. So not understanding the impact of fundamentals or the monetary policy cost me $20,000. This is why I wanted to share this video with you so that you don't make the same mistake. So if you're a technical trader, make sure you do pay some attention to the macros and the fundamentals. All right, that's it for today. If you like this video, please make sure you like, comment, and subscribe. I'll see you next time.
If you want consistency in your trading, we invite you to join our daily market analysis calls, where we provide the levels to find the best entries and targets on an intraday basis. For a 1-week free trial, please visit www.tradingwithvenus.com. Thanks for joining us today. With much gratitude, your show host, Raman Gill.